All right, well, everybody, we have a special treat today. As you may have seen on the beginning invitation and slide that you were emailed and confirmed that we have a guest speaker today. His name is Brannon Lloyd. He's out of Houston, Texas. Brannon is a very, very special type of advisor. I'm not going to spend a ton of time telling you his entire story, but I go around, as you guys probably know, all over the country, and I vet people. And as soon as I met Brannon at a conference in California. We spent 2 or 3 days together, and I said, whatever it takes, we have to get Brannon to volunteer for our organization. He has such an incredible history in this business. He has grown one of the largest college planning corporations in the country called the College Money Guys. Last year, we dubbed him the $47 million man because his firm, literally just his own firm in Houston, Texas, was able to procure over $47 million in scholarships for his clients' kids, his clients' students. And this is not FAFSA, this is not financial aid stuff. $47 million in non-needs-based scholarships. And so, he's had what I consider to be one of the most successful college planning practices in the country. And now he's parlayed that success into, I think, one of the most, high-level service and one of the most robust and comprehensive retirement planning through University Capital Wealth Management that he now runs. One of the most successful practices in that arena, too. So now he's been focusing a lot more on retirement planning, tax planning. He's got a very large team in Texas with a variety of specialists. And his Roth conversion ideas, I think, are great. So, everybody knows about Roth conversions. They've heard about them, but it's so seldom that people actually do them. And, I just didn't want you guys to miss out on this opportunity that we have right in front of us today to not just learn about Roth conversions, but also to help you guys implement how to do them. So today we're going to talk about step-by-step on the opportunity that we have to learn about Roth conversions, implement Roth conversions, and then take that one step further in terms of rebalancing your portfolio so that you can move forward into retirement knowing that you're being proactive about getting the most bang for your buck tax-wise and the most efficiency that you can possibly get for your estate and for your overall planning. So without me effusing any more information, I would like to introduce Brannon. Brannon, are you on the phone?
Yeah, good morning, Jonathan. How are you?
I'm doing great, Brannon. Thanks for being with us today, and I hope I didn't have too of a long-winded opening for you, but I just do appreciate you taking time and volunteering for organization. And just like a couple of the other people I'd mentioned from previous workshops, we fly Brannon all over the country, and because he's really in demand, and it's strictly volunteer for us. I mean, obviously, in his firm, he runs a successful organization, but all the stuff he does is volunteer for us. And he helped create some college scholarships for us last spring with a really great program we did called My Kids Got Talent, which was fun. And hopefully, Brannon, you will continue to lend us your expertise in the future for those types of events.
Jonathan, you're making me blush, but I'm happy to do it, man. It's a passion of mine, and I'm a huge geek for this stuff anyway. So 100% happy to do it anytime.
I do. You are the continuing education geek of the universe. You never stop learning, which is great. Hey, just guys, as we typically do the disclaimers, you obviously know that everybody here is a volunteer. Our foundation, by the way, has the only FINRA-reviewed nonprofit educational designations out there. So while you're reading this disclaimer, I'll also just remind you guys, there's a lot of nonprofits out there. But there are very, very few where the people that are working and volunteering and running them actually have any significant experience and credentials. Anybody can pop up and do what we do, but we have a very, very strict vetting process. And like I said, we have designations, the only ones in this area for nonprofits that are actually FINRA reviewed. We have the accountants, the attorneys, and everybody has a certain minimum level of competency, credentials, and experience in their different levels of expertise. And again, I don't believe any of the other nonprofits out there do things with that level of due diligence like we do. So again, I'm going to let Brannon, I don't want to steal Brannon's show today, but I wanted you to read the disclosure. Let's start talking about taxes. I know we need a foundation for this discussion, Brannon, about how different types of taxes work. What most people don't realize is there's a few different types of tax vehicles. Can we start with probably the most common, Brannon, and just can you tell people briefly what types of vehicles qualify under what we call the tax deductible heading?
Well, yeah, so tax deductible those are things that you can take off of your tax return. It's, tax deductible things like charitable contributions, contributions to retirement accounts. A lot of people lost the ability to deduct their mortgage interest just because they raised our standard deduction so high. But it works out better for us. But people right now, if I'll say, well, your mortgage is tax deductible, a lot of times they'll say, well, no, it's not. But actually, it is. It just may not get you over the exclusion. So things along those lines are what we consider to be tax deductible expenses. And usually, a tax deduction is done because you've done something else with your money, right? So it's not like an investment, if you will.
So the tax deductible stuff, it kind of gives you the benefit on the front end, but a lot of times what I think people miss out is, hey, if you're going to get a benefit on the front end, you're going to pay the piper on the back end, right? So the front end tax deduction may sound like a good idea. It's not always the best thing. Let's flip over, and by the way, 401ks, TSPs, SEP IRAs, we're going to go over the actual tax rates. We're going to go over the actual marginal rates and the limitations on income, but don't always jump at the opportunity to get a tax break today. I mean, it sounds like, hey, we call that libidinal gratification, right? We want instant gratification. We want tax benefits now, but you got to measure the difference of waiting, not taking the tax benefit now, and getting the tax-free on the back end. So a lot of people, Brandon, don't know what tax-deferred means. Can you just describe quickly how we describe tax-deferred?
Sure. Like tax deferred is what you think of when you think of a traditional, a qualified, if you will, retirement account, whereby you put money into this account without paying taxes on it, and then it grows over time, and you pay the taxes on the back end. So that's what we call it. So we're deferring our taxes, and we'll talk a little bit later on in this presentation about why that might be a good idea and why it might be a bad idea. And I promise you, it won't be as boring as it sounds. But yeah, any time of tax deferred, you're questioning, okay, I'm putting off paying my taxes now so I can pay them at some future date. And so, just like it says, you're deferring your taxes into the future.
Yeah, and so tax deferred is the most common type of vehicle that people use nowadays, and they defer why do something today that you can put off till tomorrow? That's sort of the mindset of a lot of people. But again, it can really come back to bite you later on, and we'll talk about it. Taxable accounts, Brandon.
Tax procrastination, if you will. So that's a great way to put it, right? So it's tax procrastination.
Taxable accounts, Brandon. So people that pay taxes on their accounts all the time, like let's say they have a mutual fund account that is not in a retirement account, and they're paying taxes on it now. Is that good or is that bad?
Well, with everything else, it depends, right? If you're paying long-term capital gains on those things, so you've held the investment for more than a year. I tell clients all the time the difference between a short-term capital gain and a long-term capital gain is 1 day, right? So you just hold on one more day. You'll drop your taxes from regular income rates, which could be as high as 38% down to 15%. So that's good. There are some real gotchas that a lot of people don't know about in taxable accounts. Like I have had the experience of having a loss on a mutual fund, as an example, but still owing taxes on the stocks that did happen to gain inside that fund, even though the overall value of the fund lost money. And so it's like it's adding insult to injury. By the way, you lost $220,000, but can you send us $50,000 in taxes, please? So that's not fun, right?
So Brandon, how does that? So people don't. And this is going to be a rude awakening. We actually did a stock market crashes for dummies workshop last time, and we talked a little bit about that. The reason why people get taxed on taxable accounts, even if they lost money, is because they don't have any control over the taxation of those accounts. So when it's a taxable account, you don't control the taxation. Even if it's a CD or if it's a savings account, you get interest. You pay taxes on it whether you use that money or not. So that lack of control is one of those things that people don't understand necessarily, what's causing that taxation.
Right. The fact that you end up paying taxes on money that you aren't actually in control of or have the use of, like you mentioned with a CD, that's not good in my opinion. Right. You're not getting that long-term capital gains 15 or depending on your income, possibly 20% tax. You're being taxed at regular income rates. Right? So unless you're in a 12% bracket or a 10% bracket, it doesn't make any sense.
And that's a great transition because we're going to go right into the marginal tax rates on the next slide, Brannon. What are some of the most popular tax-free solutions right now?
Well, the one I hear the most about, of course, is municipal bonds, which, of course, carry risk, but you aren't taxed on those gains. You're also generally not taxed by any accumulation in a life insurance contract as well. And, you know, that's pretty much the gamut for tax-free. The IRS likes their taxes, right? So, but most of the time when I hear people talking about tax-free investments, they're referring to municipal bonds.
Okay. And, of course, we'll be talking about the Roth that will fall into that tax-free category. And many people have Roths, Brannon. I see them on their statements, but most people don't have a lot of money in Roths. There was an opportunity, I think, around 2010 and 11, where there was the ability to convert to Roth and spread your taxes over multiple years, and that kind of gave us a surge in Roth contributions and conversions. But lately, people really haven't been doing much of that at all, and that's what this talk today is all about. So let's go ahead and jump right into the tax rates. And, of course, here's the 2019 and 2020 tax rates. It's really vitally important for everybody to know what tax rate they're in. Because if you don't know what tax rate you're in, then you don't know how much tax you're going to pay when you contribute money to an IRA and have to cash it out, or when you get a bonus at work, or when you get a raise, or if you need to take money out of a 401k or IRA. There's no way for you guys to know how much tax you're going to pay in any of those instances if you don't know your tax rate. So before I go into the specific brackets, Brannon, what is your general thought on where taxes are right now and where they may go in the future? And what are you talking to people about?
Jonathan, that's a great question. What I'm talking to people about right now, just to start, is the fact that we just approved an additional $2.4 trillion to our budget this year as a country, and that money has to come from somewhere, right? In addition to the fact that you look at Social Security and the fact the trust is supposed to start becoming in default in 2034. And we're spending roughly $14 trillion a year, and we're taking in taxes just under $3 trillion a year. I don't have a crystal ball, but it seems to me like taxes are going to have to go up. If everything remains the same from an election standpoint, let's say that nothing changes, Congress doesn't change any of the rules, nothing happens to our tax code. In 2026, on January 1st at midnight and 1 second on January 1st of 2026, the tax codes that we currently have under the Tax Cuts and Jobs Act are going to revert back to 2017 levels. So pretty much across the board, we know for a fact that in 5 years, our taxes are going to go up.
And that's without even some of these additional changes that might be coming down the pike as well. So exactly. I think that most people are going to be shocked when they go to pull money out of their retirement accounts to realize what tax bracket they're in. So let's start off right now. So let's start off right now and say, okay, if you're single or married in 2020, here are the different tax rates. And let's just go to, in our area, which is probably the most common tax brackets, which are people between 22 to 24% tax brackets, right? So these are married couples making anywhere between $80,000 up to $326,000. Single or individual people making anywhere between $40,000 up to $163,000. If you are in those middle income tax brackets, the 22 to 24%, these are some of the lowest taxes you guys have paid in decades. So understand that when you are in, let's just say the 24% tax bracket, and let's say you make, as a married couple, let's say you make $200,000, you're not paying 24% on the entire $200,000, right, Brannon?
That's right. You're only paying the 24% on the delta between the $200,000 and the $171,051 right there.
Yeah. So you're only paying the taxes on the additional amount, right? And so most people don't realize that. The reason why that's so important is because that's the tax you pay. Like we said, if you get a raise at work, or if you take a withdrawal from a retirement account, and these taxes are also going to affect your Social Security when you retire. So knowing and understanding your marginal rates now is just the starting point. Then what we need to do is make sure you've projected out, and I know you do this with every client, Brannon, when they walk into your office, you've got all their different levels of income that they're going to receive in retirement laid out so they can see when they put all these pieces together what type of income tax bracket they may be in retirement. How many of your clients, or what percentage of the people that you consult with, Brannon, are going to be in a lower tax bracket, even if taxes don't change, like you say? How many of them are going to be in a lower tax bracket versus the same or higher when they retire?
But when we're doing this, I don't have any hard data in front of me, but I will tell you that it's definitely less than 10% of the people that we talk to find themselves in the position of being in a lower tax bracket in retirement. And that always shocks them, right? Because we're generally told from the first day we start a job and have the ability to contribute to a retirement account that, oh, the reason why you're deferring your taxes is because you're going to be in a lower bracket in retirement. And frankly, it's just not true.
And let me just tell you, one of the most common mistakes that I see, and it's sort of like a little bit of a horrible tragedy when this happens, Brannon, and you see it too, and I know you're like, oh, what a missed opportunity. If somebody has a year where they have a lot of losses in real estate or stocks or any kind of write-offs whatsoever, and they drop down artificially low for some period of time, whether it's 1 year or 5 years or whatever it is, maybe before Social Security is kicked in, but when they drop artificially low to a 10 or 12% bracket, and they know they're going to be going back up to a 22, 24 or higher later on, what should they be thinking?
They should absolutely be thinking, how can I pay taxes at 12% as opposed to paying taxes at 22 or 24, right? And down here in Houston, Texas, of course, we're beholden to the oil industry. And, yesterday oil was at $19 a barrel. So as you can imagine, Halliburton's just announced layoffs. We're expecting layoffs again. It's really hard to look somebody in the eye and say, look, I know that you're looking at a period of time without any income, but now is a really, really good chance to start harvesting some of your taxable assets and just pay the taxes on them now, right? But
all right.
It's a great opportunity.
And I love the harvest word. So harvesting, what are the ways you can harvest? How do people harvest, Brannon?
Well, harvesting, the way I use it, right, it's just like gathering a crop. So what you're essentially doing is you're saying, okay, what is my taxable income? So that's line 10 on the new 1040. So everybody pays attention to, line 7, which is adjusted gross income. And I'm surprised by how many people think that they're taxed on their adjusted gross income, but they're not. They're taxed on line 10, which is taxable income. And harvesting is simply taking taxable, either tax deferred or tax assets that they're currently looking at and have not paid taxes on, and cashing those out, putting them into something like a Roth IRA so that they don't ever pay taxes not only on that money again, but on any future growth of that money, right? So when you're looking at compound interest and the fact that that money is growing, it really can provide you with a good opportunity. The key is just to make sure that you're not pulling out so much that you're pushing yourself into a marginal tax rate or the next highest marginal tax rate and then paying more in taxes on those last dollars.
So when you use the word harvest, Brannon, the thing that comes to mind and the way I describe it to people is, would you rather pay taxes on the apple seed or would you rather pay taxes on the apple tree? And so we want to get we want to get the taxes paid on the seed, and then we want the harvesting to come out tax-free. So you can take withdrawals from retirement accounts. You can do Roth conversions. It's essentially anything you can do to create a switch from a taxable account to a tax-free account. And let's just go right into this right now. What can we do today? So before we get into the Roths and the muni bonds and the insurance and the allocation stuff, there's something called a backdoor Roth. Do you talk to your clients about backdoor Roths, Brannon? Because not very many people know how to do them.
I talk to my clients about backdoor Roths all the time. The vast majority of my clients, not only on the wealth management side, but even on the college planning side, they make too much money to contribute to a Roth IRA because the IRS they don't like to, they want their taxes, right? And so Congress giveth and Congress taketh away. They don't realize that they don't have to worry about an income limitation if they're going to do a backdoor conversion to a Roth, and that always surprises.
Can you take us through that, just so people understand the mechanics of what that backdoor Roth really means?
Well, sure. So when you're doing a backdoor, just like the name implies, instead of putting money directly into a Roth account through the front door, in other words, just depositing money into the account, which, if your income is too high, you're prohibited from doing. Instead, what you can do is you can take money out of the back door of a qualified account like a traditional IRA, and the IRS says, there really aren't any limits to how much of that you can do, because as long as you're paying the taxes on it, they generally don't care. And so there's no income limit on doing a backdoor conversion where you're taking money out of an existing tax-deferred account and moving it into a tax-free account. The only limitation, as I said before, and as you were talking about earlier, is you just want to watch it so that you're not pushing yourself into a higher marginal rate.
So many people, Brandon, come in and say, I can't do a Roth, I can't do a backdoor Roth, I can't do a Roth conversion, I make too much money. And so for you guys out there, the limitations on a Roth contribution is $193,000 a year right now for a couple, and $122,000 a year of income for an individual. If you make more than that, you can't contribute. But that doesn't mean you can't do the backdoor, and it doesn't mean you can't do the conversion. So everybody out there is eligible to do what they call a non-deductible IRA. Anybody. You can make $1 million a year and still do a non-deductible IRA. So you can do that contribution, and it's I think it's $6,000 a year per person if you're under 50, and $7,000 a year if you're over 50. But you can do that non-deductible contribution with no limit, and then you can turn around and convert it the next day. And so most people, if you don't know how to do that, Brannon or somebody from his team or somebody from our team can walk you through it. Everybody should be doing it. And it's a very simple thing. It doesn't cost you anything, and it's a way to get more money into tax-sheltered accounts. Before I jump back to Brannon, I just wanted to also tell you guys, if you're a federal employee, I know this is not a federal retirement's best kept secrets workshop. We do have one of those scheduled in a couple weeks. But if you are under the civil service program, my dad was a civil service employee, you have the ability to take your civil service retirement account, which was the retirement account that predated the TSP. It's a non-qualified deferred comp plan. You can convert your civil service savings plan to a Roth, and you can contribute to that directly from savings or from your payroll or whatever you want to do. So we'll talk more about that in federal retirement's best kept secrets, but that is one of the very, very important loopholes that federal employees can still take benefit from. And I know you deal with a lot of federal employees out where you are as well, Brannon. Maybe not quite as many as we do, but I know you guys have a lot. So we got to get money to these tax shelters. We got to get money into Roth. We got to get money into muni bonds. We got to get money into insurance tax shelters. What else can we do today? What can we start thinking about, in terms of, hey, if we're going to do Roth conversions, why right now? Why is it such an important opportunity for us? And why is it so timely to be talking about Roth conversions?
Well, essentially, and I have to think we have a slide for this, taxes are on sale right now, right, if you will. So the way I'm explaining it to my clients is,
I do have a slide for that. Let me fast forward for you, Brannon. I'm sorry.
No, it's okay. Hang on.
There you go, right here.
There we go, right there. Okay, so prior to the crash, right? So 3 weeks ago now, let's say we had $10,000 in an account, okay, or $100,000 or $1 million in an account, but 10,000, it's easy to wrap our head around. And now all of a sudden our account had dropped to $7,000, and now it's back up to around $8,000. Well, wouldn't it make sense to pay taxes on the $8,000 as opposed to paying taxes on the $10,000? I mean, you and I both know that at some point, the last time the market really, really crashed, it took a long time to get back to even. I don't expect it's going to be that long this time around, but I could be wrong. If we know we're going to have $10,000 again, and heck, we may have $20,000 at some point, doesn't it make sense to pay the taxes on the $7,000 and then let it grow tax-free from that point? I mean, essentially, it is. You have a sale on taxes right now, essentially.
And this slide, I'm going to just walk people through the math on this slide because all I did was just add a zero to the examples that you're giving, Brannon. But if you have $100,000 in a retirement account and you double that money at 7% for 10 years, you double that money to $200. That's great, but it's all taxable. So depending on what tax bracket you're in, you may lose, let's say, a quarter of that. Your net is $150,000 after taxes. But if you do a Roth right now, you would basically pay your taxes on $100,000 today, and you would only have $75,000 to invest, right? But then the money grows and it doubles, and in 10 years that $70,000 becomes $150,000. Now that $150,000 can be out of government control for the rest of your life. It can grow tax free, but it's a triple tax free, right, Brannon? It's not just tax free to you. Who else is it tax free to?
Oh, that's correct. It's tax free to your beneficiaries, right? And it's also, another benefit that a lot of people don't think about, and it's especially pertinent from my client base, and I know from your client base as well. There's no required minimum distribution on a Roth. All right, so it's outside of government control. On a traditional type of qualified account like a 401k, a TSP, 403b, IRA, at some point, and right now it's at age 72, the IRS is going to knock on your door and say, look, you've had this money long enough. We need some taxes, please. And they're going to tell you how much of your money you have to take out every year to pay taxes on. And when we run scenarios with our clients, we find a lot of time, like I have clients whose required minimum distribution is going to be $180,000. What do you think that's going to do to their marginal tax rate?
It's going to crush them.
It's going to crush them.
So Brannon, I'm going to go to my calculator. You know what? I want people to see this math because I know you and I love doing math for our clients. I'm going to just pull this up right now. Yeah, we're math guys. Let's just show people what this really means in real dollars, okay? So here's an asset projection calculator, and this is a real simple example. But let's say you have $200,000 in the example that we just gave, right? And let's say that you are let's say you're 70 years old or 72 years old, and you have to start taking distributions out of this thing. So you would take about $8,000 of distribution out of here, which is about roughly what the required minimum distribution is. And let's say your tax rate, as we've been describing, is 25%. So based upon what Brannon was just describing, on a regular IRA, here are the taxes that come out of your $200,000 IRA. Here are the taxes that come out of your IRA each year for your distribution. And then at the end of 20 years, you're 90 years old or 92 years old. You've paid $53,000 in taxes, and you still have $199,000 in your IRA. That's, guess what? It's still taxable. So you've paid $50 in taxes. Yeah, right. And then you're going to pay taxes on all this again, either you or your spouse, your kids. Somebody's going to pay taxes on all this. It's just a tax nightmare. And with Brannon's example, I'm going to go ahead and pay my taxes now, do my $150, right? This is just real simple math, but then eliminate my RMD because you don't have to take the RMD out anymore, right? So it eliminates this tax. It zeroes out the tax. Now my $150 grows tax deferred, and we are now left with almost $400,000, Brannon. And guess how much tax we owe on that? Zero. I mean, this is not a little bit of a difference, guys. This is a world of difference. And I hated to leave the presentation, but as soon as Brannon starts talking about math, I get excited because I wanted you guys to see how powerful this is. I mean, this is like one of the most important things that people need to be doing. And as Brannon had just said, our taxes are on sale. We all need to be running out and starting to think about how we can start doing this type of stuff.
Yeah. Hey, before you switch off that, Jonathan. Oh, never mind.
Yeah, please. I can do that. Yep.
All right. So now, I just want you guys to imagine. Okay, we illustrated a 25% tax rate, right? So, so you're going to lose almost with the taxes that you pay as you're taking your distribution and the taxes that you pay on the money that has not been distributed. You're losing almost 50% of the value of that account, right?
It's almost $100,000 in taxes. That's exactly right.
Exactly. And this way you have twice as much money with 100% less tax. And I think that's a really important point to make. I'd much rather leave my family $400,000 than leave them $100,000 after taxes. And the tax burden, right? And who knows what tax bracket our kids are going to be at when they inherit our money, and who knows what the tax rates are going to be. That's exactly right. Exactly. All right, so let me stop the digression, continue back, and I need to rewind for a second here because there's a couple other things that we need to talk about that I think are really important.
So we've always talked about the rebalancing of these people's portfolios, but here's another math thing that I really want people to understand, and maybe you can explain this to them, Brandon, as I kind of just go through this. If you had a traditional planner and you had a 60/40 allocation in your investment portfolio, and that planner has not reached out to you to rebalance, or that planner is telling you to hold tight and don't do anything, I'm going to show you guys right now why that is absolutely the wrong thing. Doing nothing is not the right thing. In fact, doing nothing is seldom the right thing. So if you have a 60/40 allocation, that means 60% of your money is in stocks and 40% of your money is in fixed. Well, if the 30% of your money that's in stocks just took a hit, excuse me, if the 60% of your money that's in stocks just took a 30% hit, now you only have 42% of your money in stocks and now 58% of your money is in fixed. Your allocation is all wrong. So, Brandon, what do people need to do? What should they be doing rather than doing the nothing, and rather than holding tight? What should they be doing?
They need to be looking at how much of their money is in fixed, the fixed bucket, if you will, right? Because as you and I both know, most fixed investments a lot of times don't even keep up with inflation, right? So
especially now, yeah.
Especially now. So what you're showing here is, okay, all of a sudden you had 60% of your money, earning for you, and now you've got only 42% of your money in your. So now, because it hasn't been rebalanced, you're not getting the kind of growth, and you're also going to be missing out on the rebound, right? When the market decides it wants to go back up. I think that that's an important point to make. You've got to reach out. You've got to say, okay, we need to bring this back to our 60/40 allocation, and that may require selling some assets and moving some assets across. But it's tremendously important to get back to that 60/40 allocation if that's where you belong in your investment life today.
And this isn't just about recovery. It's about taking advantage of the volatility, because if you move your allocation now back to where it should be, and you go back to the 60/40, you're actually going to be ahead of the game then when your thing rebalances. And when you get ahead of the game, way ahead. And then when you get ahead of the game, guys, if your allocation is then too heavy on the other side, if this becomes like an 80/20 because you've made so much money on the rebound, you got to go back. This whole rebalance thing, the guys that deal with our clients, they rebalance them on a monthly basis at a minimum, and sometimes it's even daily. We have volatility controlled indexes that rebalance every single day, and that's how you take advantage. Yeah, that's how you take advantage of these different things that are going out there that we really have no control over. So that's an important thing, obviously, that I wanted to kind of drive home today. Brandon, people talk about these three phases in life all the time, but gosh, how often do you see a portfolio, Brandon, with a 45-year-old or a 55-year-old or a 65-year-old, and they all have the same company that's managing their stuff, and they're all invested in the same things?
Yeah.
How often do you see that?
The same thing. I see that all the time, right? And it's really frustrating because it kind of shows that perhaps somebody is not paying attention to their clients' growth and assets as they should be, right? The advice for a 45-year-old and the advice for a 75-year-old are completely different, right? And I will tell you, I'll make a sweeping generalization, for posterity. I can't think of a situation where a 45-year-old and an 85-year-old who are both healthy need to be in the same portfolio, right? It just doesn't.
And here's the second part of that, Brandon, that I wanted you to just comment on too. How often do you see a 65-year-old that has a taxable portfolio in mutual funds or stocks or indexes? They have a Roth portfolio and it's completely tax-free, and then they have a deferred portfolio in a 401k or an IRA, and all three of those portfolios, again, they're all invested the same.
In the same,
How often
right?
do you see that?
Diversification. Yeah, I see that often, and something else that I see as well is the Roth account is usually like the afterthought. Somebody mentioned that years ago that I should be putting some money in there, so I did. But now we have the opportunity to, a lot of companies have a Roth side of their 401k or the 403b. I know the TSP has a Roth option for contribution, right? And so, I'll tell you, there's no excuse to have money somewhere Unless your income is $500,000 now, and you can live on $60,000 a year, and you're not worried about required minimum distributions later on in the future, really, the Roth should be building up to become one of the largest pools of assets that you have, in my opinion.
It should be the primary focus. I totally agree.
Focus, right? But it's always an afterthought. They'll have $500,000 in a deferred account, and they'll have $30,000 in their Roth. And I'm looking at that and just going, okay, well, somebody has clearly not explained to you what this means.
And so let me just talk about some of the features of these Roth things that a lot of people don't realize, Brandon. Number one, you can be adding money to Roth, whether it's through your 401k Roth or your TSP Roth or the backdoor Roth. You can add money as much as you want. But if you have these other things that happen in life as you're building wealth, if you want to buy a home, you want to pay for college, you want to pay off debt, the Roth is available, right? Most people don't realize that Roth accounts are liquid compared to the retirement accounts, which are illiquid. And once in a while, Brandon, I don't know if you see this, I actually see this, once in a while, where people will be taking money, paying taxes and penalty out of their retirement accounts to pay for some of these sort of midterm, needs. And we definitely don't want to see them doing that.
I talked to a client yesterday that had done that, right, to make some improvements on their home, and they put money out of their retirement account to do it. And it's just because people just don't understand how the system works. So.
And then how important is it to shift your asset mix and your income and distribution mix so that when you get to retirement and all of a sudden you're paying yourself back in the distribution phase, how important is it to make sure you're rebalanced properly for income now and you're taking advantage of the sequence of returns and things like that?
Oh, it's critical. It's critical. And I'm really glad to see sequence of returns on this slide, because most advisors out there that I talk to still don't understand this, that actually when the ups and downs of the market occur in relation to when you're pulling money out is actually more important than the return that you're getting on the investment. And it blows people away when I illustrate this for them and show this to them. But since we can't predict when the market is going to correct or when the market is going to rebound or surge ahead, it's hard to say, well, I want to retire at age 62. And I'll always tell a client, okay, tell me what the market's going to do when you retire. And they just look at me like I'm stupid. They're like, well, I have no idea. I said, exactly, right? So it's really important to rebalance so that you're not experiencing losses at the very instant that you're reaching into those accounts to pull money out for living expenses, right? Because if what we found out looking at sequence of returns risk is that if the market is going down as you initiate your retirement, it's very, very likely that you're not going to have enough money to survive towards the end. You're going to be calling your kids and asking them for a loan or asking them for and terrible, terrible things are going to happen, right? Conversely, if the market is going up and in the year you decide to retire, there's a very good likelihood that you'll never run out of money. And understanding the relationship there and realizing that when the ups and downs occur is actually more important in retirement than how much of an up or down you get is something that surprises a lot of people. I actually teach a class on this at one of the universities here in Houston, and when we get to sequence of returns risk, everybody there is, why have we never heard of this before, right? So.
And it probably is the single greatest determining factor whether somebody's going to run out of money or not. So I know you have the calculators, and I know you have the data to show people how to accommodate for this sequence of return idea and how to make sure they don't run out of money. But it's one of those things that's so important, and so few people know how to accommodate for that. So obviously, when you're distributing money back to yourself, you really want to focus it on, do I have the ability to make some choices here? Is all my money tied up in deferred accounts? Is the government in control of all my money? Or do I have some diversification? And can I draw from other accounts that are not taxable? So that, here's the scenario, right, Brandon? Taxes go up in the future. You take less money out of your taxable stuff, and you take more money out of your tax-free. Taxes go down in the future, or they stay down like they are now. You let your tax-free grow, and you take the income you need out of your tax-deferred accounts. How many people do you really think know how to plan that on their own?
Very few. In my experience, none. very, very few. And yeah, like you said, very, very important. That gives you complete control over your marginal rate. Because if you see that, okay, my required minimum distribution is going to push me up into a higher marginal rate, right? You can maybe take less income from another source to keep it down below that rate by pulling money more heavily out of tax-free accounts like your Roth.
And people also don't realize that if you can artificially reduce your income from the taxable side in retirement, you can even spill over benefits into Social Security. Some of your Social Security may be less taxable if you plan correctly. Rather than having to pay taxes on 85% of your Social Security, maybe you can only pay taxes on 50% of your Social Security. And in fact, some of our clients, we've been able to tax plan where they don't have to pay taxes on their Social Security at all. And they've got a significant amount of wealth, but it's just all tax sheltered. And so that doesn't just help them, Brannon, right? It also helps them on this last slide, which talks about conservation. So the tax sheltering doesn't just make your life more efficient, but it passes that gift on to your kids.
That's
and
exactly
so
right.
we'll be talking about the Secure Act some more in future workshops, but I just wanted Brannon to comment a little bit about, long-term care is one of the biggest underlying concerns that people have right now going into retirement. And it may be one of the biggest expenses you ever ever pay for in your life. And how beneficial is it, Brannon, to be able to have pools of money to dip into to pay for care if you become elderly that aren't affected by the stock market and aren't affected by taxes?
Oh, it's huge, right? And so if you're, the statistics tell us, or the research tells us that currently in the United States, over 90% of our healthcare costs for our entire lifetime will occur in our last year of life, right? So it's medicine, therapies, life extension, and care for sickness or for other forms of ailment, physical, mental, right? And if you're having to pull money out and pay taxes on it, that can be devastating to the amount of money that you're going to be passing on to your children. Now, the good news is 0% of your medical expenses occur the year after, right? So,
right.
But do you really want, to leave a legacy where, because you've had tremendous amount of medical bills due to your health, now your estate is just completely devastated because it's all been spent keeping you alive, especially if you're married, right? I talk to clients all the time that tell me, well, I made mine, and so whatever my kids get is just gravy for them, so I'm not terribly concerned about that. I can understand that point, okay? Completely valid. But if you're leaving behind a spouse and you've spent your entire fortune on your medical care, what's that going to do to him or her?
And I also think that the long-term care concerns and conserving your estate is a real gift that you can really pass on to your spouse, because it shows them, and your kids obviously too, that you had some forethought and were thinking about them, not just yourself, when you were doing that kind of planning. So I think that's really important. So go ahead.
I'm sorry. Back to the point on tax planning and tax sheltering. What I hear a lot too is, back to what my kids get is going to be gravy. What they don't realize, so I have a son, and he's in his mid to late 40s or early 50s. He's making $120,000 a year, so that puts him squarely in a 22% tax bracket. What happens when all of a sudden, $500,000 of someone's estate comes through some type of vehicle that has not been properly planned from a tax standpoint? Their income goes up by $500,000 in that 1 year, right? So now, congratulations, they're no longer in a 22% bracket. Now they're in if it happens after the Tax Cuts and Jobs Act, they're in a 42% tax bracket. And, do you really want to work your entire life just to have 42% of your efforts be sucked up by Uncle Sam and the IRS? That's the question I ask.
And I know you've done this so many times and you're so experienced in this, but people don't realize the taxable distributions of their retirement accounts. So if you have a pension that's still at your employer, like a 403B or a 401K or a TSP, if it's not in an IRA, it can't be stretched, right? And even if it is stretched, obviously the Secure Act has changed the stretch rules, but people don't realize your retirement account, you just kind of breeze over it, Brandon. But people don't realize they could literally be taxing their kids as a lump sum distribution all at once. And so literally, because you were such a good saver, your kids are going to pay the penalty of all those taxes, and that isn't what anybody ever intended to have happen. So we really want to try to avoid that. The Roth completely avoids that whole scenario. And that's why we're really impressing upon you guys the importance of considering that type of financial decision. And the other thing I wanted to, yeah, go ahead, Brandon.
I said, and right now they're on sale.
Yeah, the taxes are on sale. That's a for sure, and it's an opportunity that doesn't come around that often. The last part about the long-term care I just really wanted to let people know is chronic illness expenses, assisted living care, in-home care, nursing home care, that's not tax deductible. People might say, oh, I've got these qualified medical expenses. Yeah, but the long-term care expenses are not tax deductible. So you could literally wipe out $1 million retirement account because you got to pay taxes on the account. You could literally wipe out $1 million retirement account in just a few years if you need significant amounts of long-term care when you're elderly, and that's a huge risk.
And they're not covered by Medicare either.
Right, long-term care expenses are not covered by Medicare, so it's one of those areas that I think are often overlooked, but we really need to make sure that people are reviewing those. All right, so we went over the Roth on sale idea. We can't reiterate enough how important this is, turning your taxable into tax-free and letting all your future growth happen in the tax-free. Get it out of government control and let the benefits roll down to your spouse and or your kids. And even if you don't have a spouse or kids, let the money roll down to whomever you choose. We just don't want the government being your number one beneficiary on your retirement accounts. I don't think anybody really wants that. So the no RMD is a big deal. The tax-free types times 3, tax-free growth, tax-free income, tax-free distribution. Right? Nobody's ever going to pay $1 of taxes on anything that we can get into that Roth, really ever. And the government can change the rules. Right? They can disallow conversions. They can say you can't put any money into Roth. But if your stuff's already in there, typically it's grandfathered. So let's get as much in there as we can if you have that possibility and you have the ability to do that. And then lastly, the creating the opportunity, tax planning is crucial right now. If you have the taxable accounts, if you have investments that are not in retirement accounts, you got to be harvesting and rebalancing. I mean, we don't want you paying taxes on money that you're losing, and that's what's going to happen to most of the people who don't have that type of strategy in play. And of course, Brannon, I know you use the charitable giving and the charitable trust strategy a lot. We're not going to get into this today just because we don't have the time, but how important is it for us to try to find deductions for people nowadays to be able to offset some of the taxation that's going to be happening that they're not in control of?
Oh, I think deductions are tremendously important. The ability to generate a deduction to allow you to either convert more money or earn more money without paying taxes on it is a key. It's a keystone to a good financial plan and to a good estate plan. Tremendously important.
And so we're able to really magnify the effect of Roth conversions by creating offset losses and by creating charitable deductions. So if you are only able to convert, let's say $150,000 based upon your current tax situation that made sense from traditional Roth, but if we can convert an extra $150 because of offset losses and charitable deductions, and we can double that conversion to $300, now we have $300 growing in our tax-free account, and that we showed a $200,000 example. Obviously, the $300,000 example, we would now grow to $750,000 in 20 years, tax-free to your state, spouse, kids, or whomever. I mean, these are serious potential opportunities that we really don't want to let them pass us by for a higher tax bracket, like Brannon said, in 5 years from now, or for the market recovery to happen in a taxable account. We really want market recovery to happen in a tax-free account. And that's what strategic rebalancing is all about. Do you have any other thoughts or sort of final ideas before I close, Brannon? And I know the time really flew by. Yeah, I know the time flew by.
And Brannon,
yes, sir. I know how fast your mind works. And I know how anxious you are to get started with people. How important is it that they just kind of give us the feedback and understand the resources? I mean, people don't. I mean, they always say, I don't understand how you guys are funded. I don't understand how you guys can do all this. And I'm telling you guys right now, we are a small army of volunteers all across the country, all experienced and credentialed, that I don't think there are any other organizations out there. And I know, Brandon, you do volunteer work outside of us, but how have you found the the results and the resources available through our foundation? How have you found that to be helpful to your clients and to the community?
Well, it allows them to receive advice that without a conflict of interest, right? Because we're never going to ask them for a fee. We're never going to ask them to pay a commission. We're not even going to ask them for a donation. If they want to donate, you can go to smile.amazon.com and you can actually list the Foundation for Financial Education as one of the preferred charities there. If you're working for the federal government, you have the opportunity to donate to our foundation through your payroll program. But not once have I ever had someone come into my office and sit down in front of me that I'm working with on a volunteer basis. Not once have I ever said, oh, and by the way, in order to do this, you're going to need to write me a check. No one writes us checks. And another thing that I think is just brilliant, and Jonathan, this is kudos to you specifically. The foundation doesn't have a building, right? We don't have an office building. We don't, the advisors that volunteer, we basically just use our office space, put a foundation sign up on the wall to let people know they're in the right place if they're coming to visit with the foundation. But, the foundation doesn't pay the rent. The foundation doesn't pay a mortgage, none of that stuff. So Jonathan keeps overhead unbelievably low, insists upon the fact that, we're never going to ask someone that we're working with for a dime out of their pocket. And, I have clients that they've come to meet with us for the fourth time, and they'll laugh and say, I keep waiting for the other shoe to drop. When are you going to ask me for money? Never.
The shoe never drops.
It never drops, right? So once again, I think what you've put together here, it's an honor and a true privilege for me to be able to work with the foundation. We do a lot of good. I think the research shows that, whereas over 80% of employees would like to have some kind of financial education in their workplace, less than 20% of employers are actually providing it. So the work that you do to get into the workplace, to provide people with information that without a conflict of interest, it's just tremendous, Jonathan, and really hats off to you for putting it all together, because the vision that you had is fantastic, and seeing it in fruition, I never cease to be amazed and grateful.
Well, I appreciate all that, Brannon, and of course, we want people to know that through the webinars, through teleconferences, and through GoToMeetings, our resources are available. Guys like Brannon and all the other terrific experts and volunteers that we have on our staff, they're all available for one-on-ones. We also do library workshops. We have all kinds of resources and tax planning guides. Hopefully, we'll go back to the live in-person workshops that we were doing all over the country, and especially here in D.C. I mean, we were doing 20 a month live in-person workshops, and those are really interactive and fun. But if we do eventually get back to the live ones, obviously, which I hope we will, we're not going to stop these webinars, because we want people to have access to information. We want them to receive the information in a comfortable environment. And we want to be able to give them actionable recommendations. So thank you, Brannon, for joining us today. And I really appreciate all that you do for our foundation.